Imagine a scene that feels very familiar to Americans. Not Berlin in 1923. No wheelbarrows full of cash, no price tags in the billions. Instead, it's the United States in 2022. One ordinary morning, you open your banking app. The balance looks exactly the same. No one has taken your money. No official crisis has been declared. But by the end of the month, you notice something deeply uncomfortable. That same amount of money buys noticeably less. According to an analysis by the Wall Street Journal, for the first time in more than 40 years, real incomes in the United States declined consecutively, even as nominal wages continued to rise. There was no explosion, no panic, just a quiet truth. Purchasing power was being drained month after month. This isn't dystopian fiction. This is a financial autopsy unfolding in real time. And to understand it, we can't look at the economy through day-to-day charts. We have to look at it through patterns of collapse that have repeated throughout history. The 27-year rule applied to the US. There's a number that consistently captures the attention of monetary historians. 27 years. Based on data compiled by the IMF and historical monetary research, the average lifespan of a fiat currency is about 27 years. Not because it's bad, but because every monetary system eventually reaches saturation. The US dollar left the gold standard in 1971. That means today's monetary system has existed for over 50 years, nearly twice the historical average lifespan. During that time, we've seen US national debt exceed $38 trillion interest payments, surpass military spending. The dollar's share of global reserves fall from roughly 80% to about 65%. These numbers aren't prophecies. They're data published by the Federal Reserve and international financial institutions. The point isn't that the dollar is about to collapse. The point is this: every monetary system follows a familiar pattern of decay. The 5 stages of currency decay, US lens. History shows that currency collapse is never random. It moves through 5 distinct stages. Stage 1, fiscal imbalance. Governments spend far more than they collect. In the US, persistent deficits have become the norm, not an emergency response. Stage 2, monetization. Central banks expand the money supply to cover the gap. After 2008 and again after 2020, the Federal Reserve's balance sheet expanded at an unprecedented scale. Stage 3, purchasing power loss. Inflation rises faster than wage growth. According to BLS data and Wall Street Journal analysis, most Americans fell behind the cost of living even as their paychecks technically grew. Stage 4, flight to alternatives. People begin searching for a new anchor of value. Not foreign currencies like in Lebanon, but gold, treasury bills, money market funds. Stage 5, loss of trust. The system stops functioning as a reliable store of value. The United States is not at this final stage, but all earlier stages are clearly present. And that's why we need to talk about what survives. Takeaway number 1, gold is not an investment. It's insurance. In a currency breakdown, paper wealth becomes a collective illusion. During the Weimar hyperinflation, those who held cash lost 100% of their purchasing power. Those who held gold did not. Gold produces no cash flow, no dividends, no internal growth. And that's exactly why it works. According to the World Gold Council, global central banks have been buying gold at record levels in recent years. Gold doesn't beat inflation. Gold survives inflation. It's insurance for moments when monetary systems stop being trustworthy. Takeaway number 2, the escape valve, American style. In Lebanon, the escape valve was holding physical US dollars. In the US, it's more subtle. Americans aren't pulling cash from banks to store at home. They're moving money from low-yield savings accounts into treasury bills, money market funds, according to Bloomberg. Inflows into money market funds reached historic highs in 2023-2024. This isn't panic. It's preservation. When trust weakens, people look for a more stable anchor, even if they're still using the same currency. Takeaway number 3, stocks don't die, bad businesses do. One historical paradox is that stock markets often rise during inflation, not because the economy is strong, but because stocks represent ownership of real assets. Still, not all stocks survive equally. Morningstar analysis shows two clear groups: domestic-only businesses with thin margins, companies with global revenue streams. The first group burns with the currency. The second can actually benefit from devaluation. Inflation doesn't kill stocks. Broken revenue structures do. Takeaway number 4. Skills are the only truly portable wealth. Financial assets can be frozen. Real estate can be foreclosed. Accounts can lose value. Skills cannot. After the 2008 crisis, highly leveraged homeowners lost houses, but nurses, electricians, and technicians continued earning income. According to the New York Times, practical skill-based professions proved the most resilient during downturns. Skills live in your brain. They can't be taxed away. They can't be inflated into worthlessness. If the system froze tomorrow, do you have a skill someone would trade their time or their last loaf of bread? Takeaway number 5. The lethal myth of good debt. We're often told inflation helps borrowers. History says otherwise. During the Great Depression, over 750,000 American farms were lost, not because the debt was reckless, but because income collapsed before debt could be inflated away. The same pattern appeared in 2008. Debt doesn't disappear. Income does. When systems stop functioning, zero debt becomes the safest position. Takeaway to 6. Local trust beats institutions. When institutions weaken, people return to community. After 2020, families and local networks helped people survive better than any policy announcement. Local trust outlasts institutional trust. Takeaway number 7. Tactical liquidity. You don't build long-term portfolios with consumables, but during a freeze, items with immediate utility become temporary money. The pandemic made that clear: medicine, fuel, and essential goods. This is a tactic, not a strategy. Conclusion: a personal reflection. History rarely warns us with explosions. It warns us through patterns that repeat quietly, again and again. Recognizing that changed how I think about money. Not dramatically, not through fear, but through honesty. When systems come under pressure, some things tend to hold their ground. Not because they're perfect, but because they're adaptable. Gold, not to get rich, but to stay whole. Unleveraged US dollars, not for speculation, but for flexibility. Global equities, businesses not tied to a single economy or currency. Practical skills, stored in your mind, not on a balance sheet. Local networks, where trust travels faster than institutions. And tactical liquidity, simple things that matter when systems slow down. History is also clear about what disappears quietly: long-term bonds promising certainty in an uncertain world. Savings accounts that feel safe but lose ground to inflation every year. Paper assets without real cash flow behind them. And leverage used at the wrong moment when stability disappears first. The lesson isn't to panic, and it isn't to predict collapse. It's to understand that resilience often looks boring and simple until it becomes essential. So maybe the real question isn't whether the system will fail. It's this: are you studying these economic autopsies now? Or are you waiting to become one yourself? If this perspective resonates with you, leave a comment below. How are you preparing, or are you still thinking it through? And if you want to keep exploring money through history and human behavior without fear-mongering or hype, just patterns that have repeated before, subscribe to the channel so you don't miss the next analysis.